All right, guys. How we doing?
I'm
So excited.
Yep.
All right, we're going to jump back in this. This week, it's looking like, so AP, who's AP English?
Yeah.
So, all right. So Wednesday's out for you guys. What I may do, I may still have class with the other class, and then, but I'll work it out because AP Psych is going to be out in the afternoon on Tuesday. So I may do with you guys tomorrow, let them off Tuesday. And then anyway, we'll figure something out. Right now, the test is looking like Monday, possibly Tuesday, but we'll just kind of see what we're getting in and where we are. I really don't think you guys need more than 3 days in class to work on that review sheet. That's usually a lot. So if we have the test Monday, you'd have 4. Tuesday, you'd still have 3. But anyway, today I want to jump in and talk about a couple of things. One, even though it may not, well, I want to talk about stock exchanges, kind of what they do and which ones there are in the world. And then I want to get into some calculator use. Your calculator has a great program built into it to help you kind of figure out how this money that's being invested, what it's going to look like at retirement, and maybe give you an approximate idea of maybe what you're going to want to have when you retire, how much you're going to need to invest now, that kind of stuff. It also is a really nice tool if you ever go car shopping, if you ever go house shopping, and you're like, all right, this is how much money I have right now. How much house can I get with it? Or how much car can I get with it? Because believe me, you don't want to find yourself in a car dealership staring at this beautiful car and the guy's like, oh man, you can afford it. Let me show you, blah, blah, blah. And you just kind of become a victim of really good salesmanship, and you find yourself buying a house or a car you really can't afford, which can put you in a really bad financial situation. And if you ever have to walk away from a house, which I've had friends who've had to do that in times of trouble because they couldn't afford what they've done, or even a car, it looks really bad on your credit rating, which is something I won't talk a lot about. But a credit rating is a rating that these agencies, there's 3 main credit agencies that they will give you. And it fluctuates based on how well you pay your payments, how well you pay off your credit cards, how long you've had these credit cards, have you defaulted on homes, on home loans and walked away. All those kind of things are really hard to get a good credit score. And then if you do something that's really bad on your credit, it drops really low, and then people don't loan you money anymore. And you're probably going to have to get these loans to be able to afford these homes. I don't know many people who just walk up there and pay cash for a home, especially not when you're young. So, and it is a good investment. I mean, we always talk about, putting this money away in a retirement fund or whatever, and letting it grow that way, which is a great opportunity. One thing I don't talk a ton about in this class is actually starting up your own business, which is great because, if you know you're a hard worker and you know you've got a good plan and you know you've got a good mind for a business, whether it's a nail salon or whether it's a yard, whatever landscape design business, or whether or not it's a restaurant. If you've got a good plan, investing in yourself can be probably one of the better plans you could have, as opposed to investing in a business where you have really no say whatsoever. You're just hoping they make good decisions and their stock grows. So, but anyway, the stock exchanges, there's a lot of major exchanges in the world. Well, there's not like that many. There's 6 major exchanges in the world. And I have this on page 117. And I've updated some of this stuff in here, which your information may be a little different. I think yours says around 20 million as of like 2018-19. But I updated it this year after I printed your stuff. But the major stock exchanges are the New York Stock Exchange, the NASDAQ. Both of these are in the United States. The NYSE, the New York Stock Exchange, obviously in New York, is right there on Wall Street, which you may have heard of. And forget the NASDAQ, I forget where it is, Chicago or New York. But there's also London, Tokyo, Shanghai, and Hong Kong. They're all pretty big exchanges. And these exchanges, basically, when you buy or sell stock, it all gets routed through them. Now, you might have a stockbroker or a financial guy that you deal with. You might have your money in on some online thing like E-Trade. or Schwab. Like I can buy and sell stock on my Schwab account. I don't have to call a broker. I don't even really have a broker. I used to have one, although I did not do a lot of trading. I was not one of those guys who's like constantly buying and selling because it was so expensive back in the day. But now you can buy and sell on Schwab or E-Trade for very little. I mean, it's a small fee. Some of these platforms are even free if you have a certain amount of money with them. But anyway, when I go and buy and sell, I'm buying and selling through like Schwab, which is a clearing firm. And a clearing firm is basically an agency that's set up to kind of get these things wired through Wall Street. And these clearing firms get a small commission, basically. And it used to be you had to go through a broker. So like if Anderson was a stockbroker, I would call him up and go, hey, man, I want to buy and sell some stock. He'd go, what do you want? I'd say, I want 100 shares of triple Qs. And he'd go, that's fine. I'll get your order. And he would place his order through his company's little deal, and his company would send it through a clearing firm, and the clearing firm would send it through Wall Street. And it was this long, arduous process. And that's why he got paid $67 a transaction and somebody else got paid 20. And it was a big process, very expensive process to buy and sell stock because it was so manual. Now it's all automated. And anyway, the automation, there's a lot of, well, not a lot, but there are some questions as to how it's a little hokey because you can do automated transactions that always benefit the brokers because there's constantly stuff being bought and sold. So they can take your order and they can sell it a little bit behind another order intentionally, and they can just kind of skim a 0.5%, 0.25% every time there's a transaction. And there's kind of no way to really regulate that because it happens so quickly. But there's a little hokiness going on, but there's money to be made out there with these clearing firms. They're very hard to get. I know a guy who has one. Took him a lot of time to get approved for one of these things because there's so much money and the government tries to protect people's money a lot. But anyway, they all get funneled through these stock exchanges, and there's billions and billions and billions of dollars that goes through them. There's also, if you've seen, didn't I tell y'all to watch Trading Places? Anybody watch it? Did you?
Yeah.
Nobody did their homework? Anyway, if you ever watch Trading Places, there's a couple scenes where they're on the stock floor. That still goes on. They just opened up Wall Street recently again to put people live on the floor because New York's been shut down as almost as much as anything. So they shut down Wall Street's on the floor trading. But you get a glimpse as to what it's a very live, very loud, a lot of stuff going on. But that doesn't happen on your day-to-day stock trading. It just you go in there and I can show you. Maybe I'll pull up my account and just show you how easy it is to open an account, how easy it is to fund it, how easy it is to buy and sell stock. And if I got to get a chance, I don't want y'all to see the inner workings of my portfolio, but if I can kind of get maybe I'll look into it, maybe show you tomorrow or sometime this week, what it looks like and how easy it is to buy and sell if you want to do that. And but a lot of you guys won't do that actively, but if you were wise, to me, you would be taking that at the very minimum, and I'll show you what that looks like by the end of class today, just how if you just put the minimum amount that the government allows you tax-free, if you do that for the rest of your working life from 22 to 62, you're really not going to have to worry much about retirement. I mean, you're going to be in a pretty decent place if you just did that. And when you start doing that, and you also have like your company 401k that we talked about, where the company might match some of your contributions, you do that as well. Like I put my money in, I've got a 403b going. I've got money through my teacher's retirement system. I also have the money I put in our IRAs. If you're doing all of that, especially if you are married and your spouse is doing it as well, you're going to really be in a really great place because you guys are honestly, you look around this class, you look around your AP English class, those are the brightest of the bright in this school. You may not always feel like it when you're in here, but you are the brightest of the bright. You see it when you get back in the regular classes. You're like, yeah, I really am the brightest of the bright. But you guys, the world is your oyster. You're sitting right there. You're going to be able to do, if you work hard and you care enough to be successful, you can do it. And even if success isn't measured in money, like whether you're a teacher or whether you're a social worker, you can still put this money away. If I can do it, you can do it. I've got 3 kids I've put through school, or I'm on the third one, almost done with the second. And I've been able to do it, still put some money away. you'll be able to do it too. And if you do, you're going to retire with as good or better income as you had when you were working. And but we've talked about all that. But anyway, those are the exchanges. There's, I said billions, there's trillions, $25 trillion that's caught up just in the New York Stock Exchange alone. Vast amounts of wealth are funneled through there on a regular basis. I don't know a whole lot about the other exchanges, so I'm not going to talk a ton about them, but that's the major one in the United States, biggest one in the world is the NYSE. Now, there's also indices, and this is something that I want to talk about because this is what I invest in. Somebody has created a stock, and there's actually a bunch of versions of it, but I'll talk about the two main versions that I use. There's a stock that's based on the fluctuations of the market. And these indices, there's a bunch of them out there, but one's called the Dow Jones Industrial Average. Most people just call it the Dow. And the Dow, and you can read about this, is a measure of the 30 large publicly owned companies that are in the United States. So when you see the Dow go up or down, usually that's a reflection of how those companies are doing. Sometimes it's just a perception of the world. Like when the World Trade Centers got bombed on 9/11, the markets just plunged. Well, those companies weren't doing badly, but the perception of, oh my gosh, are we going to war? How's that going to affect our economy? So a lot of times the market will move just on public perception. When you guys weren't around for this either, but when George Bush and what's his face, when they ran Gore, there was an election that was kind of contested at the end, hanging chads. I don't know if you read about that in history or whatever, but the voting machines weren't quite working very well, and Florida was up in who won Florida, and it stretched out for about a month or two, and you saw the market just getting pummeled and just dropping because it was about perception. Who's going to be in office? Who's the better candidate to really stimulate the market? And you saw it kind of dropping and dropping. So those kind of things sometimes affect the market, but the vast majority of how the market is affected is by performance or by the economy, and the economy is reflected in these indices. So like the Dow Jones, for instance, I left this is what's on your book. It was 24,083. It's just a number. Basically, every stock has a price, has a value that you would pay for that stock. So they took these 30 companies and they looked at their stock prices, and they took these and they kind of said, we're going to create an index that reflects the performance of these companies. And that index is just a number, okay? But that number was 24,000 back on April of 2018, a few years back, and now it's 34,350. So you can see it's up 10,000, which is, I don't know, roughly 40% from just a few years ago, which is a huge jump. And it doesn't always grow at 40% every 3 years. That's a really great growth rate. But you can just see in the last few years, even through the turbulence of this economy and this pandemic, it still had great growth just in this. But what people do is they watch this. And when they see this index move up, they're like, oh, the market's moving upward. That gives them confidence, and they can buy and sell on this. What people did was started looking at this and said, man, most people in the world or in our country don't have the time to watch and investigate and to study all 30 of these companies or any other companies. There's hundreds and hundreds of publicly traded companies. So what some of these firms did is they said, let's just make a stock that reflects this, because people are always looking to this. This is what's important to them. So they created a stock that reflects the Dow. And these funds that they created are index funds or ETFs, are electronically traded just like other stocks. You can buy them and sell them just like stocks. You have complete control. But essentially what you're doing is you're buying into this idea of the market. And there's a lot of different ones. Like the Dow Jones reflects the 30 largest publicly owned ones. The S&P 500 reflects the same kind of thing, the market caps on 500 of the largest companies that are on either the New York Stock Exchange or the NASDAQ exchange. And the difference between this one and say the Dow and some of the other ones is it's weighted. So like if a company is bigger, then it has a bigger weight in that index. So like obviously Apple and Amazon and companies like that are huge companies. So they will have a bigger reflection in this than some of the smaller Fortune 500 companies. but that's what the S&P does. I have probably 60% of my investment, my net worth, in something called the spiders, the SPYs. And the SPYs reflect the Standard & Poor index fund. So when I buy and sell that stock called SPY, and the SPY stock, like right here, the S&P is right now is 41.71. It was 26.39 back 3 years ago. So you can see it's still grown through a pandemic pretty well. When you consider that it's gone up 1,500 points, which is more than half that. So really great growth out of the S&P 500. But so my stock, what it does is it's basically 1/10 of this. So my current stock's trading at about 417, 419. I could look it up today and see what it is. It might be 420. Sometimes it pops, just jumps a point or two. But these stocks, which is kind of a pricey stock, sometimes I'll have a split when it starts looking kind of like, oh, $400 a share. That's a really expensive stock. They'll do what they call a stock split. And instead of owning 100 shares at that, you'll own 200 shares at 208. They'll split it in half. And I don't know, for some reason that gives people the mentality that they can afford it. But it's like cutting a pizza into more or less slices. It's still the same thing, but for some reason it stimulates that idea of buying and selling. And people will do those splits a lot. I've seen Nike once have an 8-to-1 split. Nike was just exploding back 20-something years ago, and they had an 8-to-1 stock split. I've seen Apple do that. Amazon has had huge splits, 4-to-1 splits like that over the years. But anyway, that's the S&P 500, and that mimics the S&P 500 index has a fund that mimics that. There's also the NASDAQ 100. People just call it the NASDAQ. That's a little confusing because the NASDAQ, like I mentioned earlier, is also a stock exchange, but they also have an index that reflects that, the NASDAQ or the companies that deal with, that are dealt there. But these are the non-financial companies, so you don't see banks, things like that listed in them. The NASDAQ says it's made up of 107 securities, but they call it the NASDAQ 100, so it's about 100. But they're all listed on the NASDAQ exchange, not just the NYSE and the NASDAQ. But this also has an index fund. You can see it's grown from 7,000 to 13,000. It's almost doubled in that 3-year period, which again, 50% growth over 3 years. You're talking 16, 17% growth. I'll take that. And you're not going to get that forever. You won't. The market's probably doomed to have a drop in I would say in the next couple of years. You're going to see inflation kick in. You're going to see a lot of things happen. Who knows? We'll see. But this also has an index fund linked to it called the triple Qs, or QQQ. I don't know why they picked, I guess because there's a Q in NASDAQ. But the QQQs are the other index fund that I have my money in. And then my kids, I think I have their college accounts split that way too. So I get one growing like this, one growing like the SPYs, the S&P 500. And the great thing about that is I don't have to go now and study a whole bunch of individual companies. I mean, I do have some shares from back in the 90s of like JDS Uniphase and Qualcomm and Ford Motor Company and a couple other things when I used to actually buy and sell different companies. But I was like, I got so exhausted trying to keep up with them and understand them. Everybody has a real job. Here, I'm investing in 107 companies. SPY, I'm investing in 500 companies. And I'm doing it with one click of a button by buying a share or whatever, how many shares. So the great thing about that is if one of these companies starts really struggling, like JCPenney declared bankruptcy, which it's been a slow death for companies like JCPenney and Kmart and stuff like that. But JCPenney just went bankrupt. Well, that stock price has been affected by that. So, but if I have JCPenney wound up with another 500 companies, it's not going to make a big dent, is it? But if all I do is own JCPenney and JCPenney starts getting hammered, then my whole portfolio got hammered. So buying an index fund like these is a great idea for somebody who's not a financial guy, who's not a day trader or a stock trader, who really watches the market. The downside of it is you're just going to move along with the market, nice and steady. You've seen these nice steady growth over the last 120 years. Not nice steady. From a stand back and look at it, and I'll show you an image of this in a second. You'll see this growth just starts moving up exponentially, really slowly, but exponentially. If you look really close, it's doing this and giving you heart attacks as your money goes, oh yeah, great month, great quarter, great year. Oh my God, what has happening? The world's ending. But it feels like that when you're watching it closely. But when you put in these index funds, you can just kind of go, you know what, I'm sticking it in there. I'm going to let it grow, and I'm going to trust the market. I'm going to trust our government not to fall to a foreign country and our currency to be void. I'm just going to trust that it's going to be okay. And that's probably the best thing we have when it comes to investing, unless you're making a career out of it. And even the guys I know that are active finance guys, like I have a finance degree, but guys that actually do it for a living, they're like, man, it's exhausting. I mean, I don't do it. I just kind of find an index fund. And remember, I've mentioned mutual fund. The difference between a mutual fund and this is an index fund that mimics these. And I think I have down there somewhere ETF. Maybe somewhere there's a word ETF. Anywhere, that ETF, that electronically, where'd it go? I mean, exchange traded fund. That ETF is basically a stock that mimics one of these exchanges, mimics one of the indices, and you can buy and sell it, and you're in control of when you pay your taxes. So like if you bought a share at $100 and it's now $1,000, you owe tax on $900 of that. But you don't want to pay that on your best year you've ever had as a salesman or your best year you've ever had as a company when you're in the top tax bracket. You can wait till you've had a really crappy year and go, all right, I'm in a pretty low tax bracket. I'm going to sell this stock now, pay my capital gains in a really down year where I'm in a lower tax bracket. A lot of times that's helpful as well. But you have control over that as opposed to in a mutual fund. There's some money manager in there doing it for you, and they're not for you, but for you and 100,000 other people. And he's not taking into consideration your individual situation. So to me, I love these ETFs, SPY, QQQ. Those are examples of the two that I use. There's hundreds of them out there. But anyway, that's kind of what I do. And if I'm going to show you the math of this in a second, but it really, if you just start doing it when you're 22 years old, whenever you get out of school, some of you are going to be doctors maybe. And if you're a doctor, you might not have that. Like even when you graduate from med school and they put you out, they always talk about how, when you're doing your, what's it called? Your residency. I always take internship. When you're doing your residency, they're like, yeah, but you don't make any money during your residency. And my response to that is, I know you make school teacher kind of money, but you're still making some money, right? And you're so freaking busy, you don't have time to spend it, right? I mean, you're living downtown, right near UAB or wherever you're going to school. You're working 80-hour weeks. I mean, you're just, wearing scrubs all day long. You're lucky to get a shower. Even if you're doing that, you're going to have enough money to start your retirement fund. You will, all right? They don't pay you great, but you are getting some kind of a payment. And you can certainly do that if it's a priority to you. And I would, because you've seen that exponential curve. And that exponential curve, I got this picture. You can see this. It's printed in your book, but it's kind of hard to see this. I'll zoom in a little bit, but it's not going to be a great view. But if you start this thing, this is, heck, I can't even see it, early 1900s. And you can see recessions, depressions, world wars causing dips. And this one doesn't go all the way through a current time because this is the best one I found. It was nice and colorful. But anyway, you can see, and it's got all these things that happened in history that are marked off here. But you can see this steady growth that has happened. Is that as far to the right as it goes? But you can see this nice steady growth. My hand does not work. Oh, well. You can see the steady growth that has happened in the market. And this right here, from beginning to end, was 12.7%. But you look, I picked these 40-year windows. This only went through 2007. But look, 40-year window. This is only 32. Right here, this was another 30. This was only 14. But the rates, and this one right here, this 11, which is the lowest of all of them, 2007, major market crash at the end of 2007. That was the whole, what's the movie you might have seen called The Big Short? Anybody seen that? That all was happening at the end of 2007, 2008. So even then, you're talking about 11% growth. So on any 40-year window, you're going to anywhere from 11. If you're really lucky, 14, who knows if it ends well. Like if you're retiring right about now and you're just on the back end of this massive growth swing upward and you cashed in all your chips, rolled it into some bonds or something like that, bought some property, settled down on a little farm somewhere, you're going to be in pretty decent shape. But you can see even $10 investments, what they would be worth, pretty significant money. Now, granted, that's longer than your 40-year window, but pretty significant money. Yeah, that would be a very long investment window. But you're going to get serious growth. There's another chart right here. I forgot that I put that on there. That's the Dow Jones from pre-1900 to 2018 or so. And again, you can see major dips right here. This is what, 34? That's the Great Depression. Bam, lost half of its value almost overnight. You can see 2007, this dip right here, that's the dip I experienced. And you're like, well, that's such a small dip. Well, it's a very small dip if I started in 1880 to invest. But when you start right here at 2000, I started right here-ish. So you can see, yeah, I mean, you put that money in there, you're seeing a really big hammering right there from there to there. Just absolute crushing of soul and spirit. But even since then, you've seen a huge increase. So if you drew like a nice basic curve that's going through there, yes, there's a lot of pain and suffering that you feel in the moment. But when you consider your 40-year window, that's why I'm saying just invest and forget, invest and forget. And if you do it electronically, you go to your boss, day one. Have y'all done a budget project yet? Okay, seniors are doing a budget project. Hardy was telling me, they give you like $29,000. Who can live off $29,000? Half the country. So they give you next to nothing to make you understand that you can make it work. Now, it may not be great. And I don't think anybody in here is going to graduate making $29,000 unless you, again, truly go into a field voluntarily because you want to change the world and you want to do that, and or maybe you want to be a youth pastor or whatever. Yeah, it's possible to make terrible money here, but for you intelligent people, it's going to be a choice on your part, which is fine. But you're going to be in a position most likely to really help yourself. I got off track. What was I saying?
Budget project.
Oh, and this budget project, if you can do a budget on 28, well, what if you'd had 40 then? Well, if you can get by on 28 and you suddenly are making 40, take that 12,000 and invest it. If you're like, well, I can get by on 45 and your first job's 60, well, that's $15,000. Take a chunk of that and invest it. My argument for you guys is you can make any amount of money work for yourself. If your first job is 60, this is what I would encourage you to do. Don't hear 60. When they say, hey, Mr. Spencer, thank you, it's good to have you here. We're going to pay you $60,000 a year. In your head, go, not 60, 54. You just told me 54, 54, la, 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 la. And take that $6,000 and stuff it away in your retirement fund. And then just do your budget based on 54. Are y'all hearing me? And you can do it. If you can do it on 28, which you'll do next year, you can do it on 54. If your first job is 80, congratulations. But if it is, point is, take 8, stick it away in your retirement fund. Do those matching contributions. Do that IRA. Just do it. And if you do it, believe me, when you are old and I am long gone from this earth, you will think back and go, man, I sure am glad I took that advice, because that money you get early and often is going to make the difference towards your retirement. Not the money you make when you're 40 or 50 and you really start making some serious money and you really aren't having to work 80-hour weeks anymore. You know, a lot of times I got friends, it's like, dude, when do you work? I mean, they're always playing golf and they're always going out and doing stuff. And I wonder, but point is, they're at a point in their life, the money they invest then, it's going to have some effect, but you're not going to get the same effect of that money that you get in early. All right, so be wise, even if you're probably, honestly, we are all the least wise we're going to be. Full of information, 22 years old, we got the rest of our life to gain wisdom. Be wise at that moment and say, all right, I am going to max out at the minimum. I'm going to max out what the government allows me to do. If my company allows me to have matching contributions for all that is good in the world, say yes, yes, yes. They're giving you money. They're literally handing you money. It's like getting paid to make grades. It's like, really? I can make good grades anyway, and you're going to pay me just to do it? Do it. If they're paying you money, you're just adding to that retirement fund. It's inflating it even more. But anyway, that is the majority of what I have to tell you about all this finance stuff, other than helping you understand some of this growth. I've got a couple of Oh yeah, one thing I did want to talk about was another word called annual rate of return, and the CAGR stands for something, compounded annual growth rate or something like that. But I want to talk about how an annual rate of return can be misleading. So if you ever hear somebody go, oh, hey, listen, our company's stock, just invest with us because our annual rate of return over the past 10 years has been blank. Let me show you how they calculate annual rate of return. Now, as you might imagine, an annual rate is what they have averaged each year over a past number of years, right? But the problem with that is when you average positives and negatives, a lie often happens. Let me give you an example. Let's just say you had $100, right? I got $100. And in the first year, you double your money, like double it. What growth rate is that if you go from 100 to 200 in year one? Now, what is that? It's a 100% growth rate. So you've had a 100% growth rate in year one. All right, now you have $200. What if in year two, you lose 50%? So in year two, you lose 50%. Where am I now? If I lose 50% of that, I've lost half of it, right? Where am I back? 100. So if I look at it, where am I after 2 years? The exact same spot. So I would argue that my growth in the last 2 years was 0. But guess what my average rate of return is? My average rate of return is 100 plus negative 50 divided by 2, or 25% annual growth rate. Now that's not what I averaged, is it? But that's the definition of average rate of return. Now, if everything's positive, like if I grew 100% in year one, and then 50% in year two, 50% of that's 100, that would leave me at 300. Well, if that was the case, 150 divided by 2, 75% growth rate. That actually makes sense. But every time I factor in a negative drop, it affects the truth of what my average rate of return is. But it's not a lie because that's the definition. If you really want to know, basically, where I am relative to where I start, that's called the CAGR. Not a lot of people talk about the CAGR because it's not real sexy, right? It's too much truth. And I can inflate things by just going, oh, our annual rate of return is 25%. You're like, sweet, I'm going to get 25% of my money. Oh, wait, sir. Not exactly, or ma'am, not exactly 25. It's just your annual rate. What does that mean? Well, people don't ask those questions. Hopefully you'll understand that an annual rate of return is always going to be a little more inflated than a CAGR is going to be, that rate of return, because the CAGR reflects that negative growth rate accurately. So the CAGR on my 100, 200, 100 would have been 0. It's a true reflection of where I am. It basically takes where I am now, where I am then, takes that percentage, that total percentage, and divides it by the number of years, and gives you a true estimate of how you're growing. So a lot of times when you look at the market and you see those things like annual rate of return, it gives you this illusion that you truly are going to average 11.5% or 12.5% over your lifetime. No, that's not true, unless the growth rates are always positive. Because every time you throw a negative one in there, it kind of lies a little bit. Now, rarely are you getting 100% and 50% growth and climbs. It's usually like, maybe if, like in the last 3 years, I've had these 17% growth rates. Arguably, it's pretty close to that on average, right? But then maybe I'll take a 15% dip next year. And then maybe it takes another 15%. Maybe it grows another. But when you start seeing these positives and negatives, just know that that annual rate of return kind of lies a little bit, all right? And the CAGR, you can look up CAGR calculator. I had a link to it at the beginning here, but the link's not working for some reason this year. Or maybe it went bad in the last 2 years because we didn't talk about this last year because we were, whatever, at home. But just understand that sometimes that the information you get from investment companies or financial guys, it's a little bit off when they start telling you annual rate of return. This is really what you really want to know, is because that 9.5% is really going to tell you. So this is an example of $1, I'm going to show you this on the calculator in a second. We're going to really get into it tomorrow, or the next time you're here. One growth at the end of 45 years. So your growth rate, I mean, your window's about 42 if you retired at 62, but you very well may go to 67, 70, whatever. A lot of people are getting older and working longer. Some out of necessity. Hopefully you guys will do it out of joy of your job. You'll like what you're doing. And you're like, I'm going to be bored sitting at home. I'm going to keep on working if that's what you want to do, but you'll have at least the freedom to make that choice. But at 45, you can see that $1 turned into $70. That's a single $1 investment, right? So every time you get that $1 Coke, you think about it, because it's really $70 at retirement. And that's at 9.5% CAGR, which is probably somewhere around a 10.5% annual growth rate. All right, here's $1 a month. This is $1 a month. So the difference before was one single dollar. So that's like, hey, I'm not going to drink that. I don't even know what you can buy for $1. I used to say Coke, but now Coke's like $2.50 when you go to somewhere, but whatever. That $1, instead of doing it once, what if you said, all right, I'm going to give up one Coke a month for the next 45 years? One Coke a month for the next 45 years? $8,871. That's just giving up one thing and taking that money and investing it. So you can imagine, what if you decided to put $100 a month away? $100 a month? $887. What if you did $1,000 a month? $1,000 a month? $8,871,000. And you can do these kind of things. My wife and I put more than $1,000 a month. Now, were we able to do $1,000 a month back when we were 22? No, we weren't. But my point is, if you can do just that minimum amount, you're going to be somewhere in there. And then as you get older and you make more money and you have more freedoms, you just keep piling it in. It's not like you're giving it away. You're just storing it away for later. And believe me, the time value of money is really going to make a difference for you guys. So here is, I wanted to show you this too. This is me waiting 10 years. So in the blue, this is me starting when I'm 22. And for those of you who are like, oh yeah, it's still cool, I want to go travel Europe. Whenever I hear somebody taking a gap year, and listen, find yourself if you need to figure out, there's probably nothing worse than going to college when you truly don't want to be there. You're not giving it your best. You're just wasting money and floating around. It probably is better to go and maybe get away. But know that it costs you something, because every year you don't work, you're shaving off a year off this curve. And you can see this is 5 years right here. Shaving 1 year drops that ending amount. Shave another year, drops that ending amount. Shave another year, shave another year. Every time you knock a year off, you're eating into that curve significantly when you start looking at the numbers. You know what I'm saying? Significantly, you're eating into it. So when you take a gap year, think about that, because you might be able to work another year at the end. You might not, depending on your physical ability, what's your cognitive ability. But it does take a toll, a significant toll, when you take those gap years. But again, you got to do what you got to do. And I'm not talking about taking a gap year from college. I'm talking about taking a gap year from earning. People are like, well, I want to go travel Europe for a year. I want to go do this so-and-so. If there is no earning potential there and you're not taking money and you're not able, if you're able to have your cake and eat it too, knock yourself out. If you want to go travel the world and get a job over there, like I know a girl, Zoe, who's over in Germany, and she's been there for now 2 or 3 years, and she's over there working. She went here, and you might have known her, but she's over there. She's got a job. She's making some money. She could be doing this and still investing money. She could be. I don't know if she is or not. I haven't talked to her in a couple of years, but point is, those kind of things, if you're still earning potential, still getting it away in this fund, great. But not doing anything, this is an example of a person who waited 10 years, same growth rate. Look where they ended up. So at the age of 10, this is still, if I wait 10 years, this is me at 67, this is me at 67. This person started investing 10 years later, and you're seeing this, 365 versus 8,871. Significant difference, and it's the early investing. It's the allowing it time to grow is what that person's missing out on. And that $458 a month, I think I used that $458 back when you were only allowed to invest $5,500 a year. And at $5,500 a year, that was $458 a month, I think that was. And you can see $458 a month. Right now, I would say it's $500 a month for you guys, which should be your target goal. If you can do $500 a month, and remember, if you do it before taxes, it doesn't even feel like that, because if you don't do it, government's going to take taxes out. You're going to be left with like $335. So if you get that in a month, you can see that every time you do that, you're going to, if you do that, you're going to be sitting on about 4 million. Now that's age 67, but you're sitting on 4 million from that minimum investment. And just to put it in perspective, my wife and I are doing at least 3 times that. And she's an artist, I'm a school teacher. So if you had a significant, like if you had a real job out there and you're making 6 figures, and this is not something that's overwhelming. If you have 7 kids, then maybe. But I'm just saying most people like you are going to be in a position with successful careers or good solid jobs. And you're going to be able to do this kind of stuff and get that money away, and you're putting yourself in a really good spot. Even just off this, if you're able to double this, you're doubling that. All right. So I've got 4 minutes, which is not much, but in fact, I probably am not going to have time to show you the calculator stuff. So I wanted to show you a couple of formulas. We've already talked about this one. You're going to actually have a couple of math problems on there where I give you something, a little problem, and we'll do a couple of these, and you have to pull out this formula or pull out this formula and stick in your information. It's just important to understand, is A your ending amount on both of these, P is your initial or principal amount on both these, R is your interest rate, and on these formulas, you always move the decimal. So if I say 5%, you plug in 0.05, and then T is your time in years, and then N is your what? Anybody remember that? That's your number of times you compound. So if I say compounded quarterly, you put in a 4, compounded monthly, you put in a 12, right? And then you use this one when it's continuous compounding. That's why there's no N. N would basically be infinity. And you can't really plug an infinity in there. So this is how this formula transforms into this. I think I showed you that on the back of this sheet. But your finance program that we'll get into later has different letters. So you need to start getting familiar with these. We'll talk about these. We'll walk through a bunch of problems on tomorrow's your test. No, Wednesday's your test for English. So we'll talk tomorrow about how to use your calculator on this. There's a homework assignment we'll do as well. But this should put us in a pretty good space to probably test on Monday. All right.